On today's Top Talks, episode 12. Stand by. And welcome back, Topsilogs.
Hello, hello.
With your boys, Rogelio and Randy. And today we have two special guests. Say hi, introduce yourself, gentlemen.
Say my name,
Hi.
say my name. Hello, hello. Who wants to go first?
Well, I'll go first. Nice to be back over here. Thanks for the invite. My name's Art. I'm from California.
Callie Shandy.
Hello, everybody. My name is Omar. I'm also from California.
All right.
All right.
Neighbors, right?
Neighbors.
Neighbors.
How far apart are you guys from each other?
Not far enough.
No.
Yeah.
So here in Washington State, we're having a
Yeah.
connection with California. I think today we're going to be talking about some financial advice.
Yeah. This is like a continuation of, I think, episode 2.
Episode 3.
Episode 3.
Oh, with
Art.
With Art, yeah.
Yeah,
That's right.
because we were hitting a little bit of how to plan
Yeah.
your finances
The
when you
retirement.
retire.
Yeah. Mm-hmm.
You know, for the majority, when we do talk about finances, all we always hear,
Yeah.
savings, 4-1,
Yeah.
4-3,
Yeah.
TSP, Roth, all the good stuff,
The typical stuff.
the typical stuff.
Yep.
But we don't really think about or even touch
Right.
about insurance. Because
Yeah.
sometimes insurance, when you talk about insurance,
Mm-hmm.
it's like taboo,
Mm-hmm.
right?
Yeah.
Everybody has a negative connotation when they say insurance,
Right.
right?
Well, I hear a lot about it from investors, like big money, people that they don't use the bank. They instead use life insurance.
That's true. That's
So, I'm not really privy to the whole program, but I'm trying to see how can I get involved in that life insurance.
And you know who has been in this game for quite some time?
Who's that be?
Boss Omar! How you
Yeah,
doing?
Oh, is that why we brought in the expert?
That's why we brought in the expert.
Got it.
So tell us about this the specific life insurance. What are different types of life insurances out there, and what are the pros and cons, and what's this that
Our
Yeah.
viewers can use
yeah,
and yeah.
use to help them with their finances?
And if you want to hit up a little bit about, like for the military, when we were in, everybody had SGLI.
GLI, yeah.
And then when you retire, you
Yeah.
transition to
VGLI.
VGLI.
That's true.
Okay. So, first of all, a little disclaimer, okay? So, what I discussed today is pure educational, and I think that's one of the biggest reasons why you guys are doing this is to really go out and help people, specifically in the military. First of all, I wanted to thank each and every one of you for your service. We do appreciate it, and I don't think you guys get enough credit, so we appreciate
Thank you.
that.
Yep.
So a little disclaimer. We're gonna talk a lot about, number one, we're gonna talk about taxes. I'm not an accountant, okay, so I want you guys to know that. We might even talk about some legal stuff. So I'm not a lawyer. I'm not here to sell anything, but pure educational purposes only. A lot of the things that I'm going to discuss with you, you can actually go out and go to the internet. There's books available that you can actually do your due diligence, okay, and learn about these things. Just to tell you a little bit about me, I've actually been in the financial services industry since I was in my 20s, believe it or not. I got exposed to this industry a while back. Yeah. And,
So you've been
my wife and I.
you've been in the business for 10 years.
I was gonna say 6.
10 years.
I was gonna say 6. Like that.
That's right.
Thank you. I appreciate that. What do you call the game?
Yeah.
It would have been great,
Yeah.
maybe I should have shown myself. So anyway, yeah. So, but in life, you take what you get, right, and you either learn from it or you just let it go. And so I was fortunate enough to get exposed in the financial services industry. I started out, with a company that really just invited by a friend to take a look at an opportunity in selling life insurance, and learned a lot of stuff. And then from there, got into the real estate industry.
Mm-hmm.
But when that industry crashed, I got back into the insurance industry and really studied the industry in itself. And for what I did not learn before to what I know today, it blew me away. I mean, it really blew me away. You have to understand that life insurance, in particular, that's what we're going to be talking about, it's actually a misunderstood product. Would you agree?
Let's hear it.
Yeah. It's a very misunderstood product. And so I've done some extensive studies. I went to different courses, read a lot of books, and really, and here's the best part, I didn't even know I had it before. And not knowing what I had, but it was set up where finally when I started, dissecting my own plan and really thought about, wow, this is really good. How people should really take full advantage of it. Unfortunately, a lot of the big name companies out there that you're going to see, they don't educate the consumer about this type of plan.
Why is that?
Now, well, they really rely more on people that has a lot of money, number one, and they think a lot of people like us as we don't know any better.
Is that that's why most of the people I hear about it are the rich guys.
Mm. Yeah, and then when you talk about insurance with an average person like us, it's like a chore.
Yeah.
You're like, oh, do I really need that one?
Right.
Yeah.
Because it's like, to me, unless I die, I'm not gonna get that money.
Yeah.
Well, continue.
Yeah. So I'll give you an example. Okay, I'll ask you this question, and you tell me if this is something that you wouldn't mind having. Okay. If there was a plan that when you set it up properly, okay, once you set it up, you'll never have to worry about having access to money.
Shoot.
Would you want that plan?
Forever? Free money?
Yeah, you will always have access to money. When you set it up properly, you will always have access to money.
Then you don't have to worry about nothing.
Yeah.
It's like
just always having access to money.
I mean, who
Okay,
does?
so
Yeah.
I'll start out with this. So kind of give you guys, this is pure educational. I know we only have a few limited amount of time, so I'll talk to you about the basics of life insurance.
Okay.
So in life insurance, all life insurance is actually basically based on all as far as the cost of their benefits. It's based on what they call mortality table or mortality rate, meaning the older you get, the higher your cost of your benefit.
Yeah.
Between you and me, I promise you, my cost of benefit is not higher than you. Me and I same, okay? And so, if you look at all life insurance, they're all factored in that way. And there's only two types of life insurance that you guys know. You're either going to get what they call a term insurance, okay, which offers just pure protection only. It's just like buying a car insurance.
Okay.
You pay. If nothing happens to you, what happened to all the money that you put in there?
Yeah,
Gone.
exactly.
Gone. Okay, so on a term, and the reason why they call it term insurance is because they determine the level term as far as how much you're going to pay, as far as your premium is concerned. So, example, you get paid a 5-year term, a 10-year term, a 15-year, and a 20-year term. Okay? So, my question is this. If, let's say, you're 30 years old and you got a 30-year term, which is the longest term you can get, okay, you're 30 years and you got a 30-year term, what's the likelihood that by the time you turn 31, you'll still be alive? At 61, you'll still be alive.
Yeah, I hope I.
Pretty high.
That's pretty high, right?
Pretty high.
Okay, think about this, okay? So what happened is, payment end on that 30 years, your premium on the 31st, on the 32nd year, it reverts back to the mortality rate. And the premium that you used to pay before now would be about 50 to 100 to even 200 times than what you used to pay before. So here you are at 61, right? You're looking at, you used to pay $100 a month, now you're paying $500 a month. And that's just on the 31st year. On the 32nd year, you pay $800 a month. Now let me ask you, what happened then? Can that person afford that now? No.
Not now.
No, doubt it.
Okay. And so what happened is this. Okay, that's why Penn State University did a study on all term insurance. And would you believe that less than 1% of term insurance get paid out?
Oh wow.
What a scam!
Yeah.
Wow.
Big scam.
It's a money-making opportunity for insurance company. Now, having said that, is there a room for term? Yeah, of course. If very limited money, you want to have that term policy available for the young couple while they're starting out. Okay, but unfortunately, when you mention the word insurance, people automatically assume the what? Hey, what's the cheapest?
Yeah.
Mhm.
I want to know what's the cheapest. I'm going to shop around for the cheapest policy, right? Okay. So now, the other portion of the life insurance is what they call permanent life. So you got term and permanent. Now, guess how long the permanent life insurance has been around?
Permanent.
Yeah. Well, close enough. Yeah. Would you believe that permanent life insurance, when they talk about permanent life insurance, they're referring to a savings, not to a life insurance that builds cash value.
Okay.
And the original one that was set up is what they call a whole life insurance.
I've heard that
Would you believe
before.
whole
Yeah.
life-
Gerber has a
whole
whole
life
life
insurance. Would you believe whole life insurance has been around for over 200 plus years?
Wow. 200
Yeah.
plus years.
Okay, 200 plus years. Okay, and most people are not aware of it. Okay, and the other form of permanent life insurance is what they call a universal life policy, and that one has only been around since the late 70s, early 80s. Okay, now what if I tell you? Okay, what if I tell you that the majority of people that are taking full advantage of these type of plans are the wealthiest American? I'm going to pull some away from this if you don't mind. Hold on for a second, please. I had some documents that I pulled out. Okay, would you believe that according to Wall Street Journal? Okay, hold on for a second, please. Okay, to kind of give you guys some heads up on this, and really appreciate the. Okay, so as an example, okay, Wall Street Journal talks about how the majority of plans, these permanent life insurance, are held by the richest Americans. As a matter of fact, it said, and this was back in October 2010, Wall Street Journal, okay? And they talk about Federal Reserve survey data said that 22%, that wealthiest 1% of Americans held over 22% inside this type of policy, which is whole life and universal life. As a matter of fact, even New York Times called it, okay, and this was back in, when was this? February 9, 2011. They called it as the secret for the rich, or secret for the affluent. And they talk about how it's a legal way to invest in hedge fund, other potential lucrative assets, all without paying taxes on the gain. Okay, so what do rich people do? Is they stuff money inside. That's what the same article said. They stuff money inside these type of plans, okay, because once it's inside these type of plans, okay, it's now in an environment where it's become tax free.
Right.
Okay, and that's based on the current internal revenue.
It's protected.
Because it's a different category now. The money is now insurance instead of assets or instead of capital. They can't.
Because you think about it. Now you think about it, guys. Most people are not aware of this, right? Why do the rich, okay, the top 1%, richest Americans put money into it? Okay. Now there's also a magazine called Medical Economics, magazine for doctors, and they talk about how they're influencing doctors. Hey, you should take a look at life insurance because if it's good enough for the bank, okay, if it's good enough for the bank, it must be good enough for you. Would you believe, if you're familiar with Bank of America, Bank of America put over $18 billion. Okay, these are their tier one assets. Tier one asset is like their best asset
Mm-hmm.
inside a life insurance policy. Wells Fargo, okay, 22% of their tier one asset is invested inside a life insurance policy. Now think about that. Why would the rich, the bank, all these people stuff money inside life insurance policy? And the reason being is because based on our internal revenue code, they treat the taxation differently. As long as it's stuffed inside the life insurance, and it is a life insurance, because there's certain law that was put up that it has to qualify as a life insurance. Okay? And as long as it qualifies as a life insurance, guess what?
You can't mess with it.
Somebody can put in $1 million a year. They can put in $1 million a year inside a life insurance policy, and as long as it's qualified for life insurance, all that money grows tax deferred. And guess what? This contract has a provision inside it that allows you to access all your money tax free.
Nice.
Now let's compare that to the average Joe. Where do most Americans save their money for retirement? Where do military save their money for retirement?
ESP.
In cars.
Nice cars.
Yeah, I know somebody like that. Oh, really? Okay. So, that the other bald-headed guy. Okay. So think about that. Where do more people put their money?
Well,
When you talk about saving money.
yeah, for military, they really push the
TSP.
thrift savings plan.
Yeah, TSP. Yeah.
They put a little percent into that, or some people go to the regular.
Like Vanguard.
Yeah.
IRA.
Yeah.
401k,
Yeah.
Yeah.
right?
Pretty much.
Traditional 401k.
Yeah.
Okay, so do most people or even the military understand how the TSP works or how 401k works?
They say they do. I don't think so.
Yeah.
All they
Not
know-
fully.
all
Not
they
fully.
know-
Yeah.
All they know is they put money in.
They got an idea.
Yeah.
I say not they, but yeah, we got an idea. Yeah.
Everybody says, "Oh, put it on the S fund,
Yeah. The D fund.
the D fund, or defund the
Defund
poor."
Yeah, D fund. They're defunding me
So
for real.
so a lot of the savings plan that's available today for the average American, they push a lot on their 401k or in this case in the military, you know, the TSP or tax shelter, the church savings.
Church savings.
And a lot of these savings plan are what they call a deferred plan, a deferred comp plan.
Yes.
Okay? And what happens is when you contribute to these plans, normally, okay, they allow you to defer the taxes that you pay later. Meaning, hey, we won't tax you today, okay? We won't tax you today. We'll even give you a small deduction, right? Now think about the majority of Americans today, okay? Now, I normally ask this question: what do you think the taxes that we'll be paying in the future? Do you think it's going to go down, stay the same, or go higher?
It depends on the president.
So forget that.
No, but
2024.
yeah, it will go up.
Yeah, I don't think anything is gonna go down.
No, it always goes up.
Yeah, you always, unfortunately.
Well, here's
Yeah.
the indication. Here's the indication, and if you want, you can go to this website called usdebtclock.org.
Oh.
Okay, it's a usdebtclock.org, and what it does, it shows you exactly, okay, how much in debt as a country we are. Currently, there's $34 trillion in debt.
Last time I checked was 32.
Yeah,
It's going up.
I think when I met you, Roger, it was about 18.
Yes.
Doubled up.
18
Huh?
to
Yeah.
20 trillion. Okay?
Wow.
Now,
I did that.
there's only two ways that they're gonna pay that. Okay?
Taxi.
One, is the government stop spending money,
Or my
or
money.
two, taxes people. Which one do you think they're gonna do?
Tax.
Tax the
Tax.
people.
Go to
Okay,
war.
so
Or that.
so imagine all these people deferring their taxes only to find out by the time they retire, their uncle decided to increase their tax rate. How will their retirement be? Right? And then in addition to that, who takes all the risk?
Yeah, you do.
Us.
Who takes all the risk?
Us.
You do, right?
Yeah.
Okay.
The bottom end.
So yeah. Here's the best part. Who gets paid whether you make money or not?
The banks.
The uncle.
Your stockbroker.
Yeah.
Okay? Because there's only one thing that they can guarantee you, and that is the up and down in the market. Yes?
Yeah.
The problem is, you don't know that when you retire, the money will be on the downside or on the upswing, right?
Mhm.
Okay? And then finally, you have to ask yourself this question. What kind of benefit are they giving you for holding your money that long?
2% growth.
Yeah. if that, right?
If that-
Yeah. If that. Yeah.
That's about it. Not
Okay.
much.
Not a whole lot.
All right, well, let's see. If something were to happen to you today, based on your current balance and your PSP, how much do you think your family will get from that?
That's a good question.
Yeah, Randy,
That is
what
a
is
good
it?
question.
Yeah.
I actually
Yeah.
don't know.
What
Yeah.
is it, Randy?
I actually don't know myself. Yeah.
Well,
Not a whole lot.
Randy,
But I can tell you the number is not a whole lot. It's not that big.
Believe it or not, they don't
Yeah.
get the whole thing.
Yeah.
They have to pay tax on
Oh, okay.
it. Okay, so they're not getting the whole thing.
Hmm.
All right? And you think about it,
Like
I know
60%.
you're all in the military, which is great. I hope they're paying for all your expenses as far as medical.
Right.
But think of the average Joe, if they were something catastrophic, like getting sick, for example, and not able to work for a year or so.
Right.
Yeah.
Yeah.
Where are they going to have it? If they can't work, where are they going to get the money? From their 401k? Well, if you're only contributing for 4 years, 5 years, you
Yeah.
don't really have a lot in there.
Yeah.
They penalize you plus, they penalize you 10% if you're below 59 and a half, right? Plus, you report the whole thing in taxes and you end up paying taxes. Okay, and believe it or not, these are the choices of American people. I have nothing against investing in the market, okay?
Yeah.
But planning for the future, there's got to be a better way. And that's where, believe it or not, that's where life insurance comes in.
So
That's why most people, go ahead.
no, and that's what when we talked about it a while ago in the very beginning. When everybody thinks about financial planning, it's all the good stuff: 401, TSP, Roth, RA. But when it comes to insurance, it's like really an icky subject for any individual.
Right.
And then, based on what you just said and then explained, I mean, it does have like the aha moment. Why not? Why aren't a lot of people pushing
For life insurance.
for life insurance?
Yeah, unfortunately, because your agent, your farmer agent, and again, I think I shouldn't mention names, but your typical agent, they don't educate you as a consumer. If you want to buy life insurance and you want, the permanent kind of life insurance, it's going to ask you how much you want,
Yeah.
Wow.
and that's it.
Straightforward. Yeah.
That's it.
So
They
what?
don't tell you how the whole thing works, right?
Yeah. So what is how would you know if you have a good agent that's explaining life insurance? What are like key things that we need to understand when the questions are being asked?
Yeah. So my wife, she owns she has we have agents all across the United States. Okay, my job really is to train the agent. And so when I train the agent, I sit down with them in regard to educate them as far as, first of all, at the end of the day, it's a life insurance. So you got to find out their need for life insurance.
Okay.
Okay, meaning we want to make sure that, hey, when that main breadwinner passed away, we want to make sure that their family will not be financially destitute.
Good.
Okay, we want to make sure that they're taking care of. I remember attending a course one time, and the guy said, "Would you believe life insurance is actually a love
How so?
Okay?
Yeah.
Because think about it, and here's why. Okay, think about your parents. Okay, now if they're still alive, great. All right, but if they passed away, okay, imagine if your parent, okay, passed away and they have a couple of $1 million of life insurance, and you're the main beneficiary. How would you be?
I love
Yes, you would, right?
That's number one,
them.
right?
Now, think about your children today. Do you want them to go through the same what do you call it, challenges that you have in your lifetime? Or would you rather make sure that they can have the things, the kind of lifestyle that you can leave a legacy, not just for their kids, not just for your kids, but for their kids as well.
That sounds very, very
Right.
good.
Yeah, and so that's what life insurance is. It's actually one of the greatest assets that we can have in America today. But yet, not everybody takes advantage of it. I mean, you ask family members, they have life insurance, they go, no. But you ask them, if you have car insurance? Oh, yeah, I'm fully covered.
They even have self insurance.
Yeah.
Yeah, they even have cell phone insurance. Thank you. And you tell me, you're driving home one day, you die, right? Great, your car is paid off, but your family is financially devastated. Okay? But imagine, today, each member, all of us can actually change our family's financial future. Okay? And once you understand it, you think, wow, that I can do this. That's why the rich people, that's where they stuff their money. Have you ever heard that saying, the rich get richer?
Mm-hmm.
Yeah, well, because they know they don't leave cash with their, they don't leave cash to their children. They leave life insurance because life insurance is tax free.
Yep.
Huh.
Yep. The only thing I think
Okay.
the other people, reason why they don't consider life insurance, because they're thinking about the growth of the money. They don't think about, the long term,
The trickle effect.
the trickle effect. So they're thinking about investing it, have somebody using your money
Right.
to gain equity, right, or gains.
Yeah.
But I don't think about, at the end state, like, hey, where am I gonna? When you get those gains, you're gonna get taxed. So you're gonna still lose money. But if you put in a life insurance policy, no matter how long it stays in there, how much you put in,
Yeah.
how much you put in, that's how much you get out, tax free.
That's if you continuously work so that you can
Yeah.
put in.
Yeah.
But what happens if you
If you
get
stop.
sick
And
Yeah.
get sick.
and you can't work?
Yeah, I know.
Yeah. Medical insurance.
Well, did you know that you can have all of that inside life insurance?
What?
Everything that he just said.
Speak.
Okay, so
There you go.
in the life insurance, at the very beginning, you have to understand if you're starting out, right? Let's say you're starting out, okay. One of the best things, whenever you give money to the insurance company, invest in putting money in life insurance, one of the best things that you'll get in the beginning are benefits. Okay, now I'm gonna relate that to your 401k or in this case PSP. Let's say you're contributing $300 a month. Okay.
Yep.
All right, in the PSP, right? Let's say in the past 5 years, okay, or 10 years, let's say. So that's $36,000 that you total contribution, right? Let's just say if the market was so good, it's double. Now you have $72,000. Okay?
Okay.
All
Is
right.
that how much?
You die, okay? So you die, your family will get 72,000, correct?
Yes.
Right? Minus the tax, right?
Yep.
You get sick and you need access to money. How much of the 72,000 can you access?
Hey.
Well, you can, but you
No,
get
you can access
You
all
can.
of it.
you get
All
penalized.
Oh, you
You
get
get
penalized.
penalized.
Yeah, you get penalized
Oh.
Plus you report the whole thing
as
with
income.
taxes. So you could actually end up paying 40% to 50% for whatever you took out, right? Yeah, and that's why people tell me, oh man, double 72,000. Yeah, well, if you take it out today, how much of it is really yours?
Yeah.
Mm-hmm.
Maybe half.
Maybe
Okay.
half. Yeah.
Maybe not, right?
Maybe not.
Okay, so what if I tell you that you give that same money to the insurance company?
Right.
One of the first things that they will give you is what they call immediate estate for your family. Okay, let's say based on your age, let's say you're 30-year-old, you put that $300 to the insurance company, right? And because of that, okay, you're in good health. They give you a $300,000 in life insurance because part of the benefit is the life insurance.
Okay.
You make one payment, all of a sudden, get into a car accident, you die. Guess how much they'll pay out to your family?
Dama.
$300,000. Now, if I were to ask your wife or your significant other, what would you rather receive? $72,000 minus the tax, or $300,000 tax free? Which one do you think they would rather have?
Obviously, the higher one, right?
The higher one.
My wife would say, I want it back.
Okay. So nowadays, okay, and this what really excites me is when I found out about the living benefit, and most Americans today don't know about the living benefit. Living benefit is actually attached to life insurance now, where when something catastrophic happens, like heart attack, stroke, cancer, and you survive those things, okay, you can now accelerate your death benefit. So you can have money while you're alive. So meaning, it's a life insurance that you don't have to die to use. So in the event you have something catastrophic, okay, even after you make two months payment, okay, instead of accessing your money, they allow you to access the life insurance, which is the $300,000.
Well, let me understand that. So, if I have cancer, not only
And you survive it.
and I survive it,
Mm-hmm.
Or even if you don't.
Well, you don't. The family will be happy.
yeah.
Yeah.
The $300,000.
Yeah.
And then I opt in for a let's say 300,000 policy,
Right.
and I survive my cancer. I can give me money.
Or even, I think,
Basically, that's what he's saying.
yeah, even ongoing. Even ongoing.
You can
Even ongoing,
Ongoing.
file it
so that can help with my medical bills and all that stuff.
for whatever reason. You can use it for whatever reason. So the insurance company, and unfortunately, not all insurance companies have those benefits. Okay. So what happened is you can file a claim against your total death benefit. Now, I want you to know that the amount of money you will receive from that will be based on the severity of your illness. The more severe your illness, the higher percentage that you will receive from your actual death benefit. Because what you're doing is you're accelerating. You're telling the insurance company, hey, I got this, okay? I want to file a claim and get my death benefit. So let's say it's pretty severe. Out of the $300,000 death benefit, they gave you $250,000. It's up to you whether you want to accept that or reject it. You accept it, then what happened is you're basically accelerating the $300,000 and say, give me $250 instead.
And
But
then
that
when,
is while you're still alive.
yeah,
You're basically just withdrawing earlier.
yeah.
Yeah.
And then if you do
Yeah.
go, you got 50 left.
Right.
Okay.
Like
So if
saving.
I didn't
No,
Oh,
no,
no,
let
no,
me-
no.
let me, no. Yeah, no. So some insurance company, no, you're basically cashing out your life insurance.
Oh.
Because the $300,000 only pay out when you die.
Okay.
So what you're saying is, hey, my $300,000 death benefit, I want my living benefit based on how severe my illness is.
Right.
Yep.
Okay, if it's severe, then they said, okay, well, we'll give you $250 out of the $300.
Okay.
You say, okay, I'll give up my $300, just give me $250.
I see.
I'm still alive.
Right.
Got it.
Okay.
No, can
Alright.
I reinitiate a $300,000 insurance?
Insurance, yeah. Or you just lose out on the insurance after that? Since you're taking
Right.
it,
Yeah. So what
it
happens?
ends from there.
Once you used up your $300,000, then
Yeah.
there's no more debt benefit. Now, the insurance company will allow you to access. You don't have to file against the whole $300,000.
Right.
You can file a claim against the $200,000. If you do that, let's say they offer you $150, then you still have $100,000 in debt benefit if you die. When you die,
Got it.
But that's
you
it.
follow.
You don't.
Okay.
You can't.
Yeah, that's it. Until let's say for example you suffered a stroke, okay, and I think the ruling is like 5 years.
Okay.
And you can consult a professional about that, but it's 5 years, depending on the area. So 5 years, you've been great health and so forth. Yeah, you can reapply
Okay.
and
Okay.
and so forth. So,
Got it.
and a lot of people don't know that these benefits exist.
Hmm.
Okay, and guess what? It doesn't cost you a dime. It's all inclusive in a policy. It's what they call a rider, and most people don't know about it.
Yeah.
Believe it or not, that this type of plan has only been introduced in the U.S. since 2007. But outside of that, let's say for example in Great Britain, you can't even buy a house without a living benefit life insurance.
Huh.
Because then, because look, in America, let me just share some statistics with you. In America, every year, 6 million people suffer a heart attack, stroke, cancer before reaching 65. 70% of those people will survive. Now, I'm a Filipino, and I think you guys are Filipino also, right? Guess what? Guess what?
Lechon.
The statistic is a lot higher. Why?
Lechon.
Lechon.
Putok batok.
Yeah, we call it killing me softly. Yeah. Right?
That's right.
Is
And
that
so-
because of the
and
food
you know-
or we're married?
Yes, and guess what? But yeah, most Filipinos have life insurance because we care about our family.
Yeah.
Right.
And so the problem is they don't know that these benefits exist. Okay. As a matter of fact, my son is in Everett right now, and because we're expanding our business there,
Yeah.
and so he's out there. We want doing business, and I was just out there a couple of weeks ago doing some training.
Oh,
Nice.
just stop by.
Yeah. Well, next time I will be coming back.
Bring
love
my
to meet
picture.
up with you guys.
I know.
But anyway, so I mean, as you can see, this is a lot as far as the subject
Yeah.
Right.
itself, right? But once you set it up, okay, and guess what the limit is? There is no limit. Okay,
Oh.
it's whatever you want to stuff inside the life insurance.
Yeah.
And once you establish it, guess what? You can actually utilize your cash value. And a lot of people, let me share that with you, okay? And you guys can ask any question in regard to that. Most people think that when they establish money inside the cash value, they think that they're borrowing their money, right? You ever heard that saying, that term that you can borrow cash value?
Mhm.
Yes.
Correct? And you guys heard that before, right?
Yes.
Well, believe it or not, you're actually not borrowing your own money. Okay, the insurance company will actually allow you to use your cash value as collateral.
Oh.
You know what it means by collateral?
Okay.
Yeah. That's
Okay.
guaranteed.
Just like when you buy exactly, guaranteed. So there's a provision in the contract that if you choose to pay them what they call a variable loan, your money doesn't stop making money, and your balance stays intact.
Okay.
Okay.
That's crazy.
I know.
I didn't know that, right? And most people don't know that. Okay, and that could be illustrated to you guys to show you exactly how that works.
This is all
Okay.
this is all in any life insurance.
Just specifically on universal life insurance.
Universal.
But the way
life.
you borrow it, yeah, it's all life insurance, all permanent life insurance works that way. Yes, you can utilize your cash value as collateral. As a matter of fact, I was just looking at a document here. Would you believe that J.C. Penney, okay, Disneyland, Stanford University, would you believe they all utilize life insurance as collateral to be able to fund their businesses?
Yeah. That's
Really?
free.
Yeah, that's
I didn't know you can do that though.
I thought,
Yeah.
I mean,
Yeah.
it's kind of like the same as using your stocks.
Right.
So what rich people do with stocks is they use stocks as collateral to borrow money from the banks.
Right. Nobody
That's
know
how
about
they-
insurance though. I mean,
But
I get the
Yeah, but
stocks.
the problem with stocks though is stocks is variable,
Yeah.
so it can go down, right?
Yeah.
Inside this type of plan, specifically they call this indexing. Okay,
Okay.
index universal life plan.
Right.
Okay, what it is, imagine participating in the stock market without any risk.
that's crazy.
The only time you participate is when the market goes up. Who wouldn't mind investing in that?
I know, right? Can,
Yeah.
can you
You're crazy to not.
Win-win.
win-win, right?
Yeah.
Can you tell us more about that?
Yeah, so the insurance company, you have to understand, that's why banks love them. Okay, according to that same magazine that I showed you. The reason why
Like what?
banks invest their tier one asset inside the life insurance is because unlike banks work in what they call fractional reserve requirement. Did you know that for every $100 that you put inside inside the bank. The only thing that's required for them, okay, is to put $10 inside the vault. Guess what they do with the $90?
Invest.
They invest in
No, they lend
insurance.
it back to you. How? You need a car loan?
Ah,
Oh yeah.
And then
Yeah, I
they
get
earn
it.
interest.
Why do you think they always encourage you to get credit cards?
yeah, I get it. Yeah,
They always encourage you to get a mortgage.
Yeah.
yeah,
So
that's
we
true.
can
Okay,
go.
what happened? Okay, so what happened in 2008?
Oh,
Kaboosh.
yeah.
Closed.
Trink.
How many banks? How many banks closed in 2008?
A few.
That's a lot.
Yeah, close to 300 banks. You know why?
Wow.
Because they lent out so much money. All they were taking was a collateral that people use
Which is
that
house.
ain't worth the money that what they lend it to.
The houses.
The houses. Yeah.
Okay, yes. Now compare that to the insurance company. With the insurance company, they're in what they call a reserve requirement. For every $1 that you put in, guess what they gotta have inside their vault?
A dollar.
$1.
They match, huh?
And they don't invest their money into volatile environments. They basically invest more their money either government-backed bonds or corporate bonds because they know they can give $100 million to the government and get X amount of interest, right? And they take that money to pay the people that they're guaranteeing interest rates, right? They also pay their bills with that, okay? And then so with this new indexing, what they do is they basically take a portion of that and they hedge the market. Okay, I'm sure you guys are familiar with options, right?
Yeah.
You heard of that, guys? Or in this case, related to these options to buy. So let's say you have a house that you're paying $100,000 that you're selling for $100,000.
Okay.
It won't sell. So I came to you and I say, hey Roger, I want to have an option to buy your house for $100,000 a year from now, right? So you said, okay. So let's say the going lease on the area is $1,000, but because of you want me to give you an option, I'm going to charge you $2,000. So the other $1,000 is an option price for you to have that to exercise an option a year from now. So a year from now, I look at the market. Wow, it's only $70,000. Would I exercise my option to buy it at $100,000? Of course not. Okay, but what if it's $150,000? Will I then exercise my option
Oh
to buy that house for $100,000?
Yeah.
Absolutely, right?
Yeah.
Okay. So the insurance company, when they talk about indexing, that's exactly what they do. Is they pick a particular index. I'll give you an example. The most popular one, S&P 500, right? S&P 500 is consisting of the top 500 stocks in the United States. It's just an index. So they gauge the rate of return that the client will receive based on the performance of the index. The consumer's money never gets invested directly in the stock market. So if the market goes down the following year, guess what the consumer loses? Nothing. Now, if the market goes up, now the insurance company are not crazy. Now they base their as far as their rate of return, they set what they call a cap rate, which is the maximum interest rate that you'll be receiving. Okay, typically anywhere from 12 to 15%, depending on the insurance company. I mean, would you mind getting 13%? Okay, as long as you don't get minus 13% when the market crash.
Of course, it's always a positive.
Versus 0.8%.
So
Yeah.
in other words, if the market went up 20,
Right.
they're going to give you 13. You're okay with that, right?
Yeah.
Well, yeah, because
It's
if the
not too
market
bad.
goes down 20, guess what you get? Zero.
Nothing.
2 eggs.
So you don't lose nothing, you don't gain anything.
Got
So they base it on cap. They also base it on what they call a participation rate, meaning there's a percentage that they use on the amount that you can participate in the market. So they don't cap it; they just cap it based on the participation. So as an example, let's say we will allow you to participate 80% of whatever the upswing in the market. So in this example, let's say it's the same thing, 20%, right? Well, what's 80% of 20%? 16. Right? So they'll credit your account 16%.
Oh. Okay.
Yeah, you see? So insurance companies are like that, and so, it's actually one of the great ways for people to accumulate cash, because when you're young, you're trying to accumulate this cash. You got the protection of the death benefit, for your family. You got the protection of living benefit for you in case you get sick. But if nothing happens and you put all your money inside this plan, guess what? It's accessible to you at any time to use. How would you use that? Well, let's say you use a credit card, like my son, for example, right? I started him off when he was in his 20s, early 20s. Okay, and he got into the gaming, online gaming, so he decided to build his own computer about 3-4 years later. Well, he used his credit card to buy all his computer stuff, racked in about $3,000. So he told me about it, and I asked him, "How much are you paying interest on your credit card?" He said about 20%. 20%. So guess what I did? I said, "You got money in your life insurance. Go use that. Borrow money from the insurance company. Pay off your credit card." He paid off Bank of America, right?
Okay.
Well, instead of paying Bank of America, guess what? He paid back the insurance company.
Yeah.
Because
With no interest.
once he paid back the insurance company, I asked him, "Who would you rather get the interest? B of A or B of U?"
You me.
So guess what?
I like me.
And so here's the best part, guys. Once he paid it off, guess what he continued to have?
Insurance. Life insurance.
Money, yeah.
Money.
Yeah.
So
Okay, so here's
So you-
what happened.
So you're basically investing back to yourself.
yeah,
That's basically what you're doing.
Exactly.
Yeah.
so
Have money, right? Well, guess what? Hold on. Guess what? Just recently, this year, guess what he did? He proposed to his girlfriend, and he bought her a ring. Guess what he used to buy his he used his credit card first, right?
Mm-hmm.
To buy the ring, and then after that, he took the pay off his credit card. He's paying the insurance company, and now he's almost paid off. And guess what he continued to have?
Got it.
money.
So I have a question, right? When you borrow the money from your insurance company, do you have double payment, meaning that you have to pay the
Is there
premium
interest?
and
No-
paying the debt?
Yes, you can do that because it's always good to pay down your debt, okay? Because remember, if you let's say for example you paid off your credit card, you were going to pay your credit card anyway, right?
Right. You have to. Yeah.
Yeah. I mean, why then if you are, because what happens is you become a bank. Be a good banker, right? You pay it off because once you pay it off, guess what? You continue to have
Yeah. Okay. So you basically just
Money,
borrow
right?
money from yourself.
Okay. And you can
Technically.
borrow.
exactly. You will always have money to use, right? For what? Whatever.
So it's
You
kind
know,
of
you
like
can use it.
a rolling line of credit, basically. As long as you keep paying.
That's
So
basically what it is.
So you're paying your
Yourself.
Yourself.
you're
Yeah.
paying what you owe plus what you're paying is the insurance.
What
So
you owe.
usually don't.
What you owe in your future.
But you
Basically.
can only borrow how much you put in. It's not
Yeah, so the insurance company will allow you to use 90% of whatever you have built up on your cash value.
okay.
Okay, as collateral. Yeah.
Yeah. So
Okay.
that means that
So most people,
I have to save or put in money in the insurance.
Yeah.
Let's say,
Until you get let's say 10 grand.
and then probably borrow the 10 grand, and
Got it. So you gotta build up first.
you gotta build up first.
Okay.
Yeah. Or 9,000.
and you can because look, okay, why do people borrow money?
To pay off debt.
Because they ain't got no money.
Yeah.
Yeah. Plain and simple. Yeah.
Because they keep. I mean, think about yourself. When you get paid, you paid off after paying your taxes. Where did that money go? To the bank, right?
Mm-hmm.
Okay, and then you pay off your bills, right?
Right.
Most Americans, after paying off their bills, they have money left over. Yes,
Mhm.
it's sitting in their bank account or in their checking account.
Okay.
Or
What are they giving you for holding your money?
0.8%.
Think about your balance.
Half a
Think
percent.
Think about
Not
your
a whole lot.
balance right now. Well, I mean,
Yeah.
most of the time there's people $1,000, $2,000, $3,000 inside there just sitting there.
Yeah. Not moving.
Well, what if you take 1,000 of that, put it towards your IUL, right? Yeah, forget about it, just keep putting it there. All of a sudden you start establishing your savings, right?
Mhm.
Now, guess what? Now you have access to that money.
Mm.
Anytime you need access to the money, pay off credit card. Boom, get it, then pay it off. Boom. And here's the best part: when you contribute for a long time, remember compounding interest work, right? You guys know about compounding interest, right? Money you contributing will earn interest, eventually earn interest,
Yeah.
and then
Double up,
eventually
double
your
up.
new money, old money, double up, double up.
Yep.
Well, 20, 30 years from now, when you start pulling from this, when you start using it as collateral, right? You start taking all the money out. Remember, when you take your cost base, okay, simple accounting, when you take the money that you put into these plans, you pay taxes already on those money that you're contributing, right? So when you pull that money out, you don't pay taxes on that. You only start paying taxes when you're pulling the gain, right? When you're withdrawing the gain, correct?
Yeah, yeah.
Well, that's why in this case, you don't withdraw it. You just use it as collateral.
I see. I
Because
get
when
it.
you, okay, now look at this. This is how rich people get away with it. Because if they use it as collateral, they're borrowing money, yes?
Yes.
Yeah.
Is a loan considered an income?
No.
No.
If it's not an income, do you pay taxes on it?
Nope. No.
So here's the best part. Once you start pulling money using that way, right, and eventually you die, the insurance company will deduct whatever money you owe them and pay the rest to your family tax free.
I like that.
Yeah, it's pretty good.
Hmm.
My question,
Yeah.
the question is this. I know for financials, everybody always says, "Oh, you got to start saving young," right? And then again, going back to the insurance part, it's really like pulling teeth to it, for anyone to get insured.
Yeah.
Well, what's your best advice? I mean, like, what's like a good age that people could still afford a decent insurance plan? Because I know the older you get, the more expensive it is.
Yeah.
Yeah. Okay, so first of all, the one thing I want you to remove from your vocabulary when you're setting up an IUL or permanent life insurance is expense. Why?
Okay.
Because remember, the only reason why you say it's expensive, okay, is because of the amount of money you're contributing, correct?
True.
Correct.
If it's a savings plan, let's remove the word insurance and let's focus on saving, okay?
Okay.
Would you save more money by putting away $50 a month or $500 a month?
$500 a month.
We say it again.
There you go. Would you put away more money if you were saving $50 a month
Oh,
or
okay.
$500?
Yeah.
Yeah. No. I understand. But
No. I'm trying to make a point here. Okay, because with an IUL, the only reason why you say it's expensive is because of the word insurance.
understand.
Anybody age,
Yeah.
it's like this. Like for example, people that are of age, right? Well, if you tell me, most people they said, well, what's the minimum? Okay, this is saving. What's the maximum? What's your maximum?
Yeah.
Because
No.
if you let's say you're in your 50s, right? Okay, or let's say you're in your 50s or 60s. Let's just say okay, then you're 40s even. Okay,
Yeah.
and you're trying to catch up with your retirement. Okay, and you tell me, well, Omar, I can only put away $200 a month. Well, I'll throw that question back to you. What kind of retirement do you think you'll have by saving $200 a month?
So that's perfect. So what I'm saying is, you have a lot of viewers out there that never considered insurance, and they're creeping up that age. And I get it about saving. The younger you are, the better. And it doesn't matter about cost if you could afford it.
Right.
But the issue would be is
Our young viewers.
no. Well, because there's some things with insurances that can qualify you or disqualify you, right?
Talking about like
You're talking about health
Yeah,
as
health,
well,
yeah.
right? So the older you get,
Yeah.
there may be some disqualifiers, right?
Yeah.
So, but you got some other folks that are super healthy even though at 65,
Right.
right?
Yeah.
But there's some,
Yeah, Art.
like art. So that's what I'm asking. Like
Yeah.
with your years of experience already with the insurance,
Yeah.
what is like a happy medium to where, hey, you're reaching at this age, you really need to think
Start
about
thinking
it.
about it.
Yeah, think about it.
Or hard, basically.
Yeah, don't don't disregard it because
Right.
I'm still young.
Yeah.
You know.
Say 45. Say 45.
Yeah.
So in other words, here's my answer to that. Start now,
Okay.
regardless of your age. Now, the only issue is really is money.
Mhm.
Okay, I don't care if you're 20 years old or 60 years old.
Right.
At the end of the day, it's money.
True.
Now, most people are on a fixed income, correct?
Yep.
Yeah.
If you're on a fixed income, okay, what makes you think you can put away an extra $1,000 a month if you're trying to catch up with your retirement? It's not going to happen, correct?
It's hard.
It's not
Choices.
going to happen.
Choices.
Choices.
Yeah, it's not going to happen. If you're trying to catch up with your retirement, you're in a fixed income. Let's say you make $10,000 a month. Your
Yeah.
total bill is about $8,000,
Okay.
right?
Yeah.
And now you got to put away $1,000 or $2,000 a month to be able to save for your decent retirement.
Right.
Well, if you keep doing what you're doing, nothing magical is going to happen next month where you guys can get an extra $2,000, $3,000 raise. You got to do something,
Right.
okay? And that's where making more money comes in. The only question is, what do I do? How do I make more money?
Okay.
Right? And so, that's the key because
Yeah.
saving is so important. I mean, we have a lot of agents right now that are in their mid to early 30s right now. And I'm very passionate about teaching them about saving money today. Because I'm sure you guys know, time will come real fast, just like that.
Yeah.
Yes?
Yes,
Oh,
I was
yeah.
just 40. Now I'm 45.
Yeah, I mean, and so that's why I always encourage them, man. I don't care what, $50 a month, $100, I don't care. Start today,
Right.
okay? Because if you don't, guess what? You're gonna look 5 years, 10 years from now, you go,
Yeah.
man, I should save some money.
No, last question. So,
Yeah.
yes, we get it. Start early.
Mhm.
But is there like an age to where in an insurance business or whatever insurance company it is,
Yeah.
to where you reach that age, it's just gonna be very difficult. Is there such a thing?
No, there's no such a thing. What it is that whether you're able to set aside that money. I'll give you an example. We have one agent. She's in her 70s. Guess what? She's putting away $30,000 a year.
Oh no. Let me rephrase. If like for example, now I'm 39, right?
Wow.
No, it's an example.
Example.
It's an example, right? It's an example,
I'm older than you.
right? So me as a 39-year-old male,
Well, a lot of our viewers are in that age
right?
bracket anyway.
They're in that bracket. They're
Yeah.
in that 35,
Yeah.
39,
Yeah.
right?
Yeah.
Military retirement thing.
Right.
Yeah.
So
Yeah.
I know that when I retire at 39, I could go from SGLI to VGLI.
To whatever insurance.
Whatever
Yeah.
the beautiful government term
Gotcha.
insurance,
Yep,
right?
yep.
Mhm.
Just take my money, nothing comes back.
Right.
Mario, he's
Mhm.
40
Right.
and he's also retiring,
Right.
and same thing. We both got options to
Do the same.
to go out and get our own insurances.
Yeah.
Would my age versus his age differ? Let's just say
10 years gap, maybe?
no,
5?
1 year gap.
Okay,
1 year, 2 years.
Okay.
Would it be the same bracket? Are they going to be looking at it equally?
At the end of the day, because it's a life insurance, there's going to be a cost of your benefit. Okay? You're 39 years old compared to 40-year-old. Of course, the cost of benefit will be lower to the 39 years old compared to the 40-year-old. Right?
Okay.
Okay? Setting up this, if it's a term policy, that's easy. Okay? It's just a matter of calculating monthly payments and how much you can afford and so forth.
Yep.
With an IUL, it's the same thing. It's that, based on your needs, right? Can you afford this monthly premium, your monthly contribution? Okay, so that's why sitting down with somebody that is knowledgeable in regards to really educating you and sitting down and taking what you have and trying to see where you could fit into that program. Because understand that what we want and what we can afford is totally different things.
Absolutely. Yep.
Absolutely.
Completely.
right? I mean, hey, I want $1 million life insurance.
Yeah.
Yeah, but you can't afford $1,000 a month. You can only afford $100 a month.
Yeah.
What do you do then,
Do what you can, I guess.
right?
Still term do I you all?
Yeah, well, so that's why it's so important that you sit down with somebody that will be able to show you, okay,
Right.
this is your option,
Gotcha.
right? Okay, and then apply, because at the end of the day, insurance company is more at risk than you, because hey, they'll pay out. I'll give you an example. We had one agent who applied in September. No, who applied in August.
Right.
Paid his first premium in September and died in October.
Damn.
Lord.
Yeah.
Wow.
But
What
guess
a-
what?
Wow.
About 2 months later, the wife and the daughter filed the thing, and the wife and daughter, thank God, received $265,000. And guess how old he was? He was 57
Oh,
years
man,
old.
so young.
Dang. That is
Oh.
just around
He
the corner.
died. He died on his 58th birthday.
Wow.
That's not gonna happen to us.
So
To you.
so that's the thing. At the end of the day, for us, I kind of just gave you guys a small, what do you call this? I mean, there's really a lot. That's why it's so important to work with somebody
Right.
that could kind of share with you in regards to how this whole thing works. Because if you go to YouTube right now and type that in, there's going to be some people that's going to tell you how bad IUL is.
Right.
Okay, there's one particular guy, I'm sure you guys heard of Dave Ramsey, right?
Yeah. Mm-hmm.
I agree
The
with
financial
all this stuff, but when he talked about this permanent life insurance, the IUL,
Yeah.
I mean, he hates it, right? He even created this pamphlet, about 15 reasons why you should
Should.
buy IUL.
I bet you he's
And,
insured.
and guess what? Have you ever heard that saying, he's telling the truth, but not the whole truth?
Mm.
You heard that saying before, right?
Yeah.
Yeah.
That's exactly what he does.
Sounds like social
He tells
media.
the truth.
Like social media.
Social
Yeah, like social
Yeah.
media.
Yeah, so he tells the truth about certain things, which is the truth,
Yeah.
but he doesn't tell the whole truth
Yeah.
He picks and chooses.
about the whole
Yeah.
thing.
But plus
Yeah.
he's also
Okay.
insured.
Yeah.
But a lot of the stuff they said about paying the debt first and all that stuff, I agree with that. But some of the things that he does, unfortunately, and until you sit down with somebody, right, and explain to you, no, hey, why is it so bad? Why do the wealthiest Americans put money in? Why do banks put money in? Why, is it really that bad
Right.
that they would invest billions of dollars into these plans?
Maybe just trying to scare people so that it only keeps around
I
a
know.
certain percentage.
His IUL's pretty high.
Yeah. And there's one company out there, all they do is they preach term insurance,
Right.
okay, and they tell you to just invest the difference in the market.
Mm.
Okay? I mean, that's what they do. They just tell you, and there's no living benefit on their term, unfortunately. I mean, there's companies out there, outside of that, where you can buy term insurance with living benefit.
Right.
So that's that's the what do you call this? If ever you guys want to sit down with somebody, my son is there. He's licensed in that state. So is my wife, and definitely, yeah. And again, I work with professionals, and that I have some people that work in the that actually have license. Matter of fact, I have somebody there in AC.
Yeah.
That is licensed
Right.
individual that
Right.
can actually show you this stuff.
So
I'm
for our viewers, if you guys are interested in
Yeah.
a very interesting topic, I mean, not really pretty on all the information about life insurance, and I'm pretty sure there's some of our viewers want to get deep into the subject.
Well,
I do have something though from you. I think sounds like we're closing in into the end of this podcast. But what do you think that you can share to not just us here but to everybody else that's watching us? That basically, in the nutshell, like it's like a takeaway from you. You know what I mean? What would you?
for me, it's all about educating yourself, right?
Right.
And as far as going out and really just because a lot of people, especially the one that's getting hurt the most are middle American, of course, the average
Right.
Joe, right? Because what we do is we rely a lot on social media, we rely a lot on what our other people say, what Uncle Joe, and so forth, and we really never take the time to really educate ourselves in regards to these type of plans. I
Okay.
gave you the choices to start saving money, right?
Right.
And that's and most people will continue to do that, not understanding about how these things work. And so go out and ask questions. I think more than anything, ask questions. Based on what you heard today, don't.
Right.
I always say, don't listen to me. Go fact check what I say.
Yeah.
Go, and what do you call this? Research yourself in regard to, because that's what I did.
Yeah.
I couldn't believe it. I had the plan already. I didn't even know I had the plan.
So-
until I started doing it, I said, man, this is good one.
Yeah.
And for our viewers, if you do have questions, please post your in the comments.
Yeah.
And I'll welcome Art and Oscar.
Omar.
Omar.
Yeah.
And ask Omar to once in a while screen the comment section, see if there's any questions that you might be able to answer for our future viewers.
Right.
Yeah.
Yeah.
Yep.
With that said, any final thoughts, Art, Omar?
Yeah, well, for me, it's so grateful now. For me, I thank you for having me. I mean, it's really, a treat for me just being able to chat with you guys. This is my first time doing this,
Right.
and I'm grateful that I'm able to share something. I hope your viewer got something out of it, and if any of your viewers are looking to want more information, I mean, they can reach out to you, of course, and we'll try to get some right people to be able to sit down with them and talk to them about it and just
Right.
show them exactly.
Yeah.
what this stuff
Do you have like a
is.
website that they could go to you?
Yeah, actually, you can go to actually, Art, why don't you give him what do you call it? Because Art actually, in addition to what he does, he actually one of my what do you call it that I work with, that I trained, and so he can kind of be a go-to guide, and also I'll try to get the guy from safety.
Or they can use this platform.
Yeah,
Or they can use this platform. I mean,
Yeah.
this can be the middle. Yeah, the middle person, so to speak.
Yeah.
This
Yeah,
platform.
I mean, we would do that.
I might be out there in Washington next month or so love to sit down.
Yeah.
Oh, yeah.
Yeah.
And kind of work, then that way you guys can tell your viewers, man, that thing is incredible.
Most definitely. Hey, it's not free tickets to your conference.
Yeah.
But with that said, Mr. Art, do you have anything to say?
Well, my thing is just for me, like I said on the episode today, I started everything when I was getting out. Insurance was one of my priority. Everybody got a term insurance in my house, And when I learned about the IUL, hey, guess what? I moved everybody to IUL. So it's never too late. Start them early. Started my kids when they were 17 and 18. Like Omar said, his firstborn that's been living in Washington, he started with the early 20s. So as long as you can afford it, do something about it. I mean, in the long run, hey, it's good. It's good benefits, and it's a good protection for your family and everything like that. So,
Well, thank you. And then, again, thank you, gentlemen, for joining us to our podcast.
Yep.
For our viewers, hey, it's just one of the information that you may use put in your tool bag. And if you're really interested, just hit us up in the comment section. Again, we'll link you up with Mr. Omar and Art. I'm really interested, so I wouldn't be surprised if any of you guys are willing to listen.
You gotta get with the guy from Lacey, Mario.
Okay, I'll get with the guy. But with that said,
Yeah.
gentlemen, you guys have any final thoughts?
Yeah, we appreciate you guys.
Thank you for
Thank you.
coming over here.
Yeah. And for our viewers, thanks again for showing up and joining us in our Top Talks.
Yeah.
Until next time, episode 13. Appreciate you guys.
IUL.
Parang
IUL.
IUD.